right? And many times you see one person that breaks away from it that no one believes. No one turns to this guy for an answer, but he's got the right answer. One person. And he had to turn against the gigantic crowd. And the problem with the crowd, the problem with being in that crowd, is that you have a temporary comfort of belonging. And that is a false god. This is a fantastic quote. I wish I could find the name of the individual who came up with this. It was a rant. It sounded like a kid, like a young guy in his 20s, like ranting along with a song. It was quite interesting. Anyhow, dig into that at some other point. But you get the idea. So let's go into this, the mechanism at play here, so you get a very clear idea how this is rigged. Now, there's 1,000,000,001 YouTube videos right now out there with market makers this, market makers that, and it's a head shaker. But at the same time, I think those people that you get what you pay for, right? So if you're getting the freebie stuff that's twisted and has been mangled and to somebody's opinion of it, well, then you're not going to get the juice. So I want to make sure in this first 10-minute section here of this DMR here on the 14th of April 2020, you get the juice of this, because if this idea bleeds into all of your chart analysis, bleeds into your dialogue that you have when you put a trade on, when you're managing a trade, when you're taking a trade off, when you're doing a check down, when you're analyzing markets, if this dialogue stays with you, then I've done something for you of value. All right. It's very important that you understand what I'm talking about when I talk about the inner dialogue, because as you're putting trades on, as you're making decisions, you're going to have this dialogue, whether you recognize it or not. Okay. So let's talk about what's happening in this moment when the crowd thinks it's right and most people are long a market. And let's talk about this price point right here where we're seeing this dribble over. Now, we didn't talk about the 1, 2, 3 up, but that is usually a momentum move that gets a lot of people thinking the crowd is moving. I've got to get with the crowd. I've got to be right. And so they get with this crowd and they go long in this area. So there ends up being far more buyers than sellers at this point of the market. Okay, now, before I go on to this next slide that's going to show you the stop losses of the crowd, I want you to think about this. And in your mind, or if you're watching this as a video recording, go ahead and click pause. I want you to draw in what's happening with the stop losses of these participants in the market. Remember, the yellow line represents current price. And I see a lot of people in MT4, they use that bid-ask line in the MT4 to show current price. I don't like it. I'd rather use a bid-ask indicator. What is the bid-ask indicator, you might wonder? It's this little, well, it's actually not in the WSM viewer. It should be. But it's the little hatch mark thingy right here. That's the bid-ask. I'd much prefer it to hide itself on the far right edge. I don't need to see this thing go all the way back to the left of the chart. I like it right here on the edge. Okay, we'll talk about that trade in a second. I like it right here on the edge. See that bid-ask? But anyhow, I want you to think about this. What's going on here? Where are the stops of these people? I've given you half of the equation here, okay? And if you don't challenge yourself this way as a potential manipulatee, the manipulator is going to want to turn you into a manipulatee. And the first way they do it is to keep you ignorant of this kind of stuff, right? So if you're ignorant of the way imbalances of the order book line up, you're ready to pray to your false god. You're ready to get on your hands and knees and give him your stop losses. Okay? And again, I want you to know why the market moves. It's one thing to be able to see patterns, timing, levels, all that kind of stuff, but I want you to know specifically why this stuff happens. And again, that dethrones this false impression of markets, which, believe me, it's almost worth an entire DMR. But the way that our education is set up, and I've done long DMRs on this, John Taylor Gatto and people like that stripped out the Prussian aspect of our foundational education. But it's a way into the market is your enthusiasm and excitement of joining the crowd to make money. And that image is put across all financial media. It's put across all investment education, right? And so here we're looking at something that's the exact opposite of that, right? When are you going to loan a company money? Well, of course, when they prove themselves. How are you going to know they prove themselves? Where their stock is rising nice and strong. Okay, they have a good fundamentals. Now I'm going to go ahead and go long that company at the exact time that everybody else is going long that company. And something happens with the stops. What happens with the stops, guys? Sharks are correct, but anybody want to be specific? I need specifics here. And just also, if you guys can, let me know if you hear any digital breakups in the audio. That would be most helpful. I think I've got my stuff happening here. Little spit particles were getting on the capsule and the microphone. It was terrible. But when they land, it makes a splat. Okay, so I haven't heard anybody type in where the stops are. So what's going on with the stops? Can you basically tell me what's happening with these stops? All right, some more specifics coming through. Like to see that. Okay. Okay, good. So a couple people are understanding this. Let's just make sure we're clear about this, okay? Remember, the sellers, there's a certain amount of sellers at this price point. Their stops will be where? Above the market. The sellers' stops will be very few because the sellers in this market are very few. The buyers, on the other hand, are many, and their stops are many. And yes, Brad and Farham, the seller's stops are tiny, and the buyer's stops are large, and the buyer's stops sit below the market. This is where all their stops are. Now, if you are a high-tech liquidity provider, coordinator / market maker, small group of people that are able to harness the resources of the international banks, harness the resources of the individual liquidity providers that those banks provide, and see all that data on a screen, I would strongly suspect that they have some sort of aggregate view like this. They're able to see where all the stops are at any given time on both sides of the market, and they get a picture like this, right? I know these colors are a little faded, so I could have made this brighter, but I want you to just understand this principle because this is everything that's going on. This is everything that's going on. Now, this is not to say that this move will absolutely come down here and immediately crush these stops because they're all there. There might be some objective that the dealer wants to make where he needs these stops to be of a certain size in order to run them. So he can create another additional momentum move that's going to load more buyers in and therefore add to the stops that are sitting below the market, right? And of course, it's hitting the stops of the sellers, but that's almost inconsequential. There's just not a lot of money up there for the dealer to take off the table. This is all cash straight into his bank account right here. You have to look from his side of the view, his side of the screen. You have to view from his side of the screen and come to terms with the fact that on the market making side, this game is so easy. It's just, your screen populates with a certain amount of stops. You have some agenda for the amount of money you want to have load up down here. And once these babies get to a certain size and your objective is met, well, yeah, the dealer will whack right through them in a heartbeat. And that is your shift bar, right? The house always wins. So he'll come through all of these stops, obviously with, a bit of pullbacks. There's a certain momentum that he uses. There's a certain cadence, as it were, that he uses that we will look at tonight together, right? I think we'll do about 15 minutes of our COVID, and we'll do an hour and 15 of trading. So what you see here, again, you see these pushes, pullbacks, push, pullback. Each one of these is clipping a set of stop losses in the market, right? And they're targeting it. Oftentimes they'll come down to one gigantic batch of stops down here, buyer stops, and then turn the market right around on a dime on that area. So part of your investigation has to be, where are the stops? Where would I put my stop if I were a monkey going long this market? If I believed that the crowd itself, based on its size, held a quality of decision making that was ideal, and I wanted to chase that thing, where would I put my stops? And that's going to give you a window into how far the shift bar goes. That's going to give you a window into what's really going on in this market. Again, trying to get this idea into your brain. It's so funny. The traits of, I don't use this, don't try to find a politically correct word here. The traits of the vicious dealer's playbook that we're talking about, right? The qualities of it. The qualities of it are two. One of the qualities is that it's the same thing over and over again, right? It's a rig that enough people haven't caught on to that they can do over and over and over again. So it's repetition. It's just brutal repetition. And it's repetition with this inducement, this false momentum, with this deceptive layer. So let's do this again with everybody not being able to see it. And then because they don't see it, we'll do it again. Because they don't see it, we'll do it again. And it feeds on itself, okay? So this is, right, kind of how things work. So from the standpoint of the dealer, it's a very easy game, right? You're sitting in front of a screen. You see all these basically buy orders in here, which is what a sell stop is. You're essentially going to buy these orders up from people. So you're seeing the stops all the way through here, right? So all these stops are in the market. You see it, and you see just a few stops above. And you can calculate what it's going to cost you to run price down to here. And then you can calculate how much you're going to gain from the stops. And you can actually be net positive or net negative. And that's what the dealer's waiting for. All he has to do is make more than he spends, right? So if he brings this market down, that's going to cost him a certain amount of currency to do that, right? Selling or buying pairs, right? Does the stop losses in the market make up for that amount? Now, of course, as soon as he pulls price back into the range after one of these stop runs, well, then that figure balances out significantly, meaning that all he has to do is make more than he's spending. And he sees all the orders sitting down here. He sees all the orders sitting up here. And that's why these structures work constantly. But you need to get to the point that instead of seeing, I don't know, I don't want to diss it, but you're all a little bit too indicator happy for my taste, but that's all right. That's what we're here for, is to push you to the next level. But you see the movements because of this going on, not because an indicator is hitting a baseline or whatever. That's not the reason it's happening. It's happening because the market makers are driving it. That's why. So make sure when you're looking at those indicators to always reverse engineer the dialogue to reflect the reality. Very important. And then it's gone, right? So that's what happens. All this money gone. And I know you guys know the meme here, right? It's a great video. It's absolutely perfect for what's going on here. Okay? And this is how the rig is run in leverage trading. There is nothing else to it. I mean, it's as brutal simple as what I just explained to you. And we dealt with it in terms of the away from peak lessons that I've given a couple times. I've drawn this out and we've stretched it out a little longer and taken in this whole thing in more detail. But this idea needs to sit front and center in your trading dialogue, because the capital markets have this big shark out there, right? It's not this pretty happy, even markets where everybody's, invited in and it's equal and supply and demand are all basically, no. It's rigged and there's a shark in the tank. Okay. So that shark in the tank is what's doing a lot of the movement. Now, it's not all of the movement, right? We know the market makers aren't wealthy enough to be in all markets at the same time. But when they are grabbing onto a piece of meat, they will shake it, they will chew it, they will leave chum in the water, and we swim along and like a pilot fish pick up the little pieces that this guy makes. So you need to be friendly with him. I dare say be friendly with the shark. Okay? So again, the leverage markets are rigged this way. And this is something I want you to become intimately familiar with as your journey goes forward in your trading career. Induce, trap, shift, repeat. The repeat part is very important because the repeat part is the same thing, but it relies on the emotions of having been stung the first time. When you're first shifted out of a position, when you have been taken out as a momentum long buyer, and you get your emotions starting to heat up, and this market starts to head back up in the direction you originally thought that it was going to go, and you add a long position in there, that's when the kill shot really gets you, because oftentimes you're using too much leverage. All right? And my question for you is, can you develop your self-talk inner dialogue to reflect this reality of the game board? And yes, it's a game board, right? As serious as people are about money, the people that do really well with trading are able to lose a couple, win a couple, lose one, win three, lose one, win four, lose one, win two, lose three, win one, lose one, win three. I mean, this is the reality of any trading strategy you have. I don't care what you're doing. Right? This is it over time. Clusters of losses, right? Clusters of losses, break even. The blue is break even. The red are stop outs. The green is a win. Okay. So start of the year, fantastic. A bunch of wins and then some break evens. Wins and break evens. Everything's fine. Whoops. Starting to drop one, drop another, drop a few more. See how those stop losses come in? Right? The game mentality would blow right through that, right? Because your risk has already built up your account quite nicely at this point. You've had, in this case, 9 weeks of good action in this GJM1 trade that you went back and meticulously analyzed each day. right? Found wins and losses. Sometimes the wins happen right after the losses, and sometimes the losses are 3 in a row in a day. Your setup happens 3 times and it fails. But that doesn't seem to happen a lot as you go further down. Again, you see losses. I mean, this is the game board. This is the reality of trading right here. So pursuing this idea of being a winner all the time is ridiculous. That's another fallacy. Add that to the list of hokum that comes at us, right? So again, you travel through your signature trade through an entire year here. This is 2019 of a particular M1 strategy that I like, right? I've seen some losses. I've seen some wins, right? Some ups and downs. Okay. I can see my overall curve of this thing. I can see the August break. I think that's during August, right? But that's pretty much it. It pretty much cooked right through. So August and December didn't perform all that well. My hit rate, obvious, 75% hit rate, which is fantastic, with a 19% break-even rate. 32 stops, 31 stop losses to break even. You can see that's a lot of stop losses to break even, actually, and 97 wins. That was 2019 in GJ, right? I know the pair. I know the setup. I'm clear with it. This is the game board. This is the reality that you're going to face. Break evens, loss, win, break even, win, over the course of weeks here. Loss, win, same day, win, loss, win. This is reality. Okay, so just get that into your skull quickly, and then reflect this dialogue and understand that you yourself aren't able to see all those stops all pretty painted in the market like the dealer is. Like, you understand that you're not going to have this pretty picture of all these lovely stop loss orders and very few. You don't have that advantage, so you can't expect to be 100% in your assessment. A lot of times they do run it one level further, so you have to expect to be right about 75-80% of the time. Anything over 70 is going to get you in good stead. Basically, 65% would be the low edge. 65% and above, you can definitely make money in this business. But when you get to 75 and 75s, 80s, mid 70s and 80s, you're in a really good spot. Okay, so again, it is a game board. The game is played through wins and losses and break evens, and those should basically hit you like little water droplets. They shouldn't be like a frying pan in the face. Okay. And so how do we study this? How do we get our brain into this idea of this movement between the shark and the participants all believing the validity of the crowd based on its size, not based on the quality of its decisions? How do we do this? What is our method to study any given setup, right? And that would be employing a timeline of events to solidify the perception of price. So solidifying the perception of price along a timeline from left to right is the way to do it. And I want to invite you to go back into the Type 1 London Pattern 3-part deep dive series at the top of my video section in the forum. And we tear apart a single Type 1 London pattern, chopping it up into pieces with these impulse corrections, all the material that sits inside of this idea of employing a timeline to events, right? All these events happen. And that is the other side of the coin, is that because we are limited in our perception of how the dealer truly runs things, we have to be smarter. We just have to be smarter. And the best way to be smarter is to not try to take in all the details at once. You're never going to be able to take in all the details at once. I remember a perception test that was given in my late 20s, early 30s as I was doing continuing education after college. I was challenged with an image to try to remember. It was a big image. We'll just use this as an example. They had individual elements all around a single screen. It was insane. It was probably like nothing I'd seen before. It was all sorts of images, items, familiar items, cars, dogs, cats, bells, whistles, bird, everything. It was stuck across the screen. And the idea was, in 15 seconds, can you look at the screen and then write down how many things you saw, and then look at how you did as a percentage of the items that were on the screen. And it was literally impossible to see 100% of them. I mean, it was just littered with items. But you did it the first time and you wrote down maybe 9 or 10 things. And then you did it a second time. And the second time you did it, they taught you an element and they said, break up the screen into quadrants. Start on the far left, look at just this area and write down what you see. And then look at the center section, write down what you see, and then look at the right-hand section and write down what you see. And of course, you wrote it afterwards, right? You didn't write it as you were looking at it. As you were looking at it, you couldn't write. So it was you used a 5-second scan of the left, a 5-second scan to the center, a 5-second scan on the right. And lo and behold, everybody doubled the amount of stuff they saw in the image in the same amount of time. Of course, they used another image. The second image was not the same as the first image. So the test was neutral in that regard. But as a participant, you realize that the key to perception is a lot of little pieces together form a larger image. It's never everything all at once from the standpoint of your intellect. That would be your conscious mind. Your conscious mind will never be capable of doing a nonlinear type of perception until it's at one with your spirit within, which is possible as well. But that's another dialogue. But as traders, we're being pushed into trying to be as perceptive as possible, see everything, see all these little pieces that fit together. And it's the same thing as that perception test. It was a wonderful test. And it was, frankly, every time I'd walk by a showroom window on, Fifth Avenue or whatnot, I'd start to do this thing in my head at just kind of randomly. I'd say, okay, take this piece, this piece, and what did you see? And walking down the street, I'd recall what I saw. And it became a lot easier to see more by doing that. So you're carving it up into little fragments, and then your perception is able to pick out those elements. It's strange. It's weird the way that happens, but it works, right? So what we're talking about in terms of these timeline elements that we're memorizing of a given setup, and I suppose it's probably a good time to go look into a setup from last night, being that we did a pre-market last night. This was our euro dollar. Anybody want to take a swack? I mean, not everybody here that's present was part of the pre-market. Would you take a swack at what kind of level identification you have on this particular chart right now in EU and what your trade is going to be? Anybody want to pop it out there? Anybody? And remember, you can look into the distances here, and this is why we use these for the WSM viewer. This is a 0-0 figure, 25, 50, 75, 0-0. They're spread out by 25 pips. So our first hint here, besides the 1, 2, 3 up that's marked for you, is that from the top of this pin to the close of the day is at least 50 pips. 25, 50, a little more than 50. Call it 60 pips to the close of the day. That should tell you something, right? So yeah, Nick, you're correct. So let's just show what we had for it last night because it is relevant to this discussion for EU. We had 1 part AFP short. We had 1 part level 2 long. Okay. Outside structure to the long side. So you need a really good reason to hold past that outside structure. If we took a short, that outside structure would provide a certain amount of trap volume. Okay. So that was what we had. Let's go look at the outcome. It's very interesting how this worked out. It became a very nice type 2 London pattern. Sorry about that peak reset line. That shouldn't be there. But we were trading away from peak, right? So the inducement of the crowd brought a lot of people long at this point. Stop runs against them, and then re-induce, re-trapping, and re-shifting. The kill shot was right here. And you see, oftentimes I take pictures just as it turns around. So from my standpoint of doing a whole lot of algorithmic work with one of these type of deals, where I go back and look at the wins, losses, and break-evens, and I tweak my strategy to try to get this number as high as possible, I found that 2-to-1s, that is 1 unit of risk for 2 units of gain, pretty much universally would get my numbers in the high 70s, 80%. So if I took a 2-to-1 on this particular type 2 London pattern away from peak that happened last night, you can see the 2-to-1 is very clearly achievable in this. If I were looking for 3-to-1, 4-to-1, 5-to-1, it would obviously be a much bigger run. Now, this is taking it off the 5-minute chart. Right? We can see the inducement up once, twice, and 3 times. Look at the 3 hits to the high. 1, 2, 3. Notice the entry is right when Frankfurt opens. That's Frankfurt, Germany. That's when a lot of liquidity comes in the Forex markets. That's the open. Okay, fantastic 2-to-1. Now, stop loss would be above the high of the day. Right? Again, sorry about this peak reset line. That was an error. It shouldn't be there. But stop loss above that 50 with an entry in this area, you can see it. It's almost 2-to-1. It's a little bit under 2-to-1. Okay? So my target in a lot of my trading, believe it or not, and I strongly encourage people to think this through. My target a lot of times is between 1.7 and 2-to-1. 1.7 units of risk to 2 units of risk. Okay? And the reason for that, all right, this is where I want to make this. I almost want to change the setting here and turn echo on the mic or something, get a different perception because I want you to see this. Right? We want to make money. We don't want to be a trading superhero. Okay? Isn't the idea to make money, or is it the idea to be some sort of, God or something. You know, there's this tendency, and it's a problem with trade groups. And Steve mentioned this back in 2011, 2012. Trade groups, there's a tendency to try to be the, you want to do that super bomber trade that's at 30-1 and share it with everybody. And oh my God, it's like, but it goes against this idea of single base hits that you use in order to build an account slowly and steadily, right? So for me, a 1.7, a 2-1 with a stop far enough outside of the reach of the dealer has me emotionally absolutely flatline. I can be just as clear as possible with that type of structure. If I want to get a super tight stop inside here, I have to worry about the dealer coming up and knocking out my order. And of course, last night you can see our spreads are starting to get down, which is nice. EU, you have a better chance of getting a -5 or a -3 stop loss on it. But for me, a -10, a -11, a -12, something proportional to this type 2 London pattern that gives me a 2-1 out of it is my target, is my objective, because I want to make money every day, because I know that compounding is what the force of growth for my account is going to be compounding, not these superhero home runs. And when you're starting out, I'd say if you go for 3-1 or more starting out, you're going to have a tough time doing that, right? You are. And you're going to have hit and miss. You're not going to have a 75% hit rate. Your hit rate's going to drop into the 60s, right? Any of the guys that came in our group that did the M1 stuff with a 5-pip stop and, super beautiful, the high of the day, top tick or bottom tick, that guarantee you they were all 60% hit rates. They just had incredible reward to risk ratios. That's fine for them. That's cool. I've done that. I've played in that sandbox for a while. It's a little bit, I don't know what it is. It stirs up too many emotions for me. I just want to make money. I don't want to get into complications. And you're talking about somebody who used to only do the high-low entry. If I weren't in by the top 5 pips of the market, I wouldn't trade. This is the old style of Jim trading. That was my old style. I started getting into the 5-minute about 2 years ago. And it became a lot easier to just make money. I mean, you're here to make money. You're not here to be a superman or superwoman. Okay? So to me, a 2-1 is as respectable as anything else if I can show a 75% hit rate on that. Okay? So now we all know what this pair did. Okay? Sticking with our projection, right? We had the let's go over here. That was our short. Okay? You can see how it came into the zone flip, right? Ready to take off on this move. Again, you can count 1, 2, and 3 down. And then it turned right back around and did what? Can you see what setup that is? And again, I don't like covering other instructor setups, but when they do happen, they should be discussed, right? See that setup? And again, I use ID50s a lot to make sure I'm not trading against an ID50, right? So if I'm in a London pattern and all of a sudden this thing loops back and turns into an ID50 in line with all the EMAs, I'm out. So at very, 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 very worst, you would have cut this trade for possibly a loss of the spread with that ID50 that showed up. So I do encourage you to study other instructors' trades, if just to stay out of the market when some of those trades fire in the proper direction. If you've gone back and done some type of algo historical validation of those trade setups, which I've done in ID50s a little bit, not a lot, but I did Steve's technique of using a 30 trade series. Studying IDs, they're still way above 50%. So I know if I'm trading against an ID50 short, that's not my trade long, but I know that I can take off my type 2 London pattern that I would have been in away from peak. You all see that? I want to make that really clear. ID50. Okay, here's your 52 and a cross. Comes back down, then close above, right? And car's always looking for this to be at least 25 pips, this pullback. Okay, in line with all the EMAs. Does that make sense to everyone? I hope so. Okay. So that was some nice trading from last night. Okay, so employing a timeline of events. And what that means is you're going to start to chop up any setup. I don't care what it is. If it's a Doug setup, if it's a Steve setup, if it's a car setup, if it's a Jim setup, you need to start to slice these things up as key events happen. You need to get a timeline idea all the way into take profit. And then when you get to the take profit, obviously, there's no need of having the timeline continue. But you need to have this intimacy with price and time, which for most people never happens in trading, and it has to do with the tools that they're using or not using. Okay, we know the WSM viewer is just absolutely king for doing this, right? Because we can park it in certain areas. We'll get to this trade up from last week, right? But you can park it in certain areas and dial it forward and dial it back, and you'll be able to get those timeline increments that are so necessary for trading. The other key piece of the puzzle, obviously, is learning how to have a linear decrease. Sorry about the typo here. I flipped the chart over and didn't change the text here. But in our drawdowns, in our losses, we want to keep a linear pullback. In our gains, we want to have our exponential gains, okay? So you need to learn how to do that. That's a math equation, right? Linear pullbacks, linear drawdowns. When you take a loss, it should be a linear pullback. When you have a gain, it should be an exponential gain. You should learn how to do that in your trading. And that's a math thing. This has absolutely nothing to do with this timeline across the charts idea here. Nothing to do with it at all. It's a separate discipline. It's the discipline of linear versus exponential math. It's lot sizing. It's getting a sense of a water line and working your way above the water line and only adding in to risk when you have a degree of positive float above that water line. It's a slightly complicated concept until you wrap your brain around it, but I do want to get people involved in it from an intraday basis as well. I was intending to do another add-on to the M1 microcycle series talking about just this thing. We will do it. I will do it. It has to happen. It's where you're using the waterline as a start of the day and you're amping up your risk as you dial into your positions, right? So anyhow, that's, again, from someone who's actually done it, you may not need to do that. Again, we're trying to keep you from being a superhero and trying to make sure that you just make money. Okay? The quiet person that just makes money day in and day out is going to be a whole lot better than the superhero that can razzle and dazzle you with trades and Skype. I don't want you to be that guy or that girl. Avoid those people, frankly. Okay, and take it for I was one of those. Trust me, right? You go back in the forum, you'll see all this crazy business that I was doing in New York, which is useful for many people, but I don't trade that way anymore because I've learned how to do it with a lot more order and far less chaos. So let's just go into this idea here. For a trader, for someone that's learning the art of trading, it starts out as sheer chaos. This teaching will come at you as just a barrel of marbles spilled on your floor. You'll be absolutely overwhelmed by it. You need to put all these pieces together. And again, I'm reflecting in a sense with an email that I got from someone that didn't like didn't see a slickness of this education. It's really the content that matters, not how it's presented at this point. But I'm responding to this because it is valid. You need to know where the center of the trading education is. You should know exactly where to start, right? We talked about that, of course, with that little diagram there, talking about the main class and then boot camp and then DMRs, right? That should be evident at this point. But there's part of this education, I alluded to this last time, that you can't actually do as a teacher. The student has to do it. And this is one of the key puzzle pieces that sits out here that has yet to be stuck into the matrix. It needs to be put into the puzzle piece here. So you can be shown the road, but you yourself have to walk it. And again, I come back to this lesson we did a couple weeks ago, right? Everything in life programs us. You have to choose your programming wisely. So that becomes a choice of what you're going to allow into your subconscious mind. And I dare say a lot of us allow a lot of junk into the subconscious mind. I don't even need to go outside of trading all that much, but you can, right? So in this session from March 3rd, we talked about this flow of reasoning, impulsive actions versus reasoning actions. We talked about this subconscious and how it grabs onto a picture. We put this little quote up: reason obeys itself, ignorance submits to whatever is dictated to it. These types of ideas. This is the person who's breaking away from being comfortable with the size of the crowd as somehow being proportional to its correct decision making. This person is breaking away from that crowd, right? Which really needs to be you, right? The size of the crowd is not proportional to the value of the decision it's making. Okay. 90% lose 90% of their accounts in the first 90 days. That's the reality of the Forex market. That actually is what keeps the game going. That's what allows these kill shots to be so lucrative. Your objective is how to not act in line with that 90%. And a lot of you are well on your way to not being that 90%. And again, I'll maintain and I'll continue this rant going forward that being the super hitter of 10-1 and 12-1 and oh my God, I doubled my account in 1 week, that kind of stuff, these superstar hotshots that like to come up in Skype groups and all that kind of stuff, that to me is still part of the 90%. Right? To be that 10% is to be quiet. It's to just get your pips and go on with your life, So this again, I'm trying to shake you out of this idea of trying to follow other people. There's a point at which this education turns very early. And I dare say it's basically, to be honest with you, it's right after Steve's class. You should start immediately after Steve's class looking at charts yourself. walking through looking for those London patterns, because basically that class, that 3-day class, is basically the London pattern class. Then the boot camp obviously is him working with you, but as soon as you get out that 3-day class, you're on your own. You have to look at it that way, right? You're walking the road, and it's a long road. Okay, learning how to lose correctly with math precision. That's the idea of lot sizing and using this idea of a water line to have your day start, week start, account start, right? You work your way above the water line, you ease back into the water line. Know what that means. And that's basically how to not bleed when you hit the pavement, because, my friends, you will hit the pavement. This is trading after all, right? You're going to hit the pavement, just as a reality. I want you to remember that the superstar, superhero, top tick with a 2-pip stop dude is going to get slammed by these stop outs here, okay? Or lady, right? So be careful of that mentality of having that somehow a 1.7 and 2 to 1 is somehow, oh, you're just not in that elite class of traders. But no, stop it. 1 to 1 is great. If you think about it, if you do the math, it's amazing, okay? So don't be that person. You have to learn how to not bleed when you hit the pavement. What does that mean? That means you're going to take stops. Okay, look through here. There's stops. There's blood on this page. There's blood on this M1 GJ trade that I love. I'll take in my sleep if I have to, right? It doesn't happen every week. Like once in a while, it's the low end once a week. Here's a break even for an entire week. It's not always there. So any good trade setup is going to obviously have its series of wins and series of losses, but you're not going to bleed when you hit the pavement. That you have to learn. You have to learn to do that. And that means you have to fall. And that means you have to be wrong. And if you're wrong in your trading, can that be part of you learning a multidimensional discipline? Is you failing of value to you that you see that as part of what you have to learn in a multidimensional discipline? You need to get that okayness to fall. You need to be able to take a stop loss. You have to be able to be wrong and work that into your mathematics so you can be wrong and lose correctly, right? And that's a big deal when it comes to any leverage market. It's so important. So these separate disciplines can strip them out, all of them. There's math component, which is how to not bleed when you hit the pavement, right? There's the pattern recognition component, which is totally creative mind, subconscious mind, and how you program yourself and how life programs you. And then choosing your programming wisely so you do recognize these patterns, right? Then you have statistics. Statistics is obviously a big part of it. Statistics would be very relevant to this picture. If I add up this entire year of trading and I'm grabbing on average 1.9 to 1 reward risk ratio setups, pardon me, I can do the math and I can see that I end up with a nice take on the matter. And then if I run it up to a 3 to 1, my win rate's going to go way down. My win rate's going to be in the mid 60s. Okay. So with a 1.7 to 1, I get up to 75, 80%. I like that idea. That's a statistical analysis there. It has nothing to do with pattern recognition, right? Absolutely nothing to do with pattern recognition. It has nothing to do with math, really. Statistics does, in a sense, has to do with math, but statistics is it's an application of math that's different than determining leverage. It's more about the probabilities. How many times does it win? How many times does it loses? How many times does it lose in a row? That's a key idea, right? So this right here, again, hot shots and superstars will get slammed by that type of thing. Okay, so just be aware of that. Be aware of that. Okay, and then of course the latter part, self-programming, is in relation to pattern recognition, and that has a lot to do with after the entry of the trade, how you act in the market after the entry of the trade, and that's all self-programming. So these are varied disciplines, right? They're not the same thing. So I put this out there just. Again, and I see a lot of people doing this, and I'm really happy you're doing this. And this is when I get the emails of, oh, I'm so happy I'm doing really well. And the person gets really quiet, but they're making money. And that's when you get to the point of doing 3 hours of WSM Viewer chart time for every 1 hour of video presentation instruction. 3 to 1. 3 hours on the road, right? Walking through these setups. We might as well look at this one from last week at some point here. I mean, that was pretty nice, right? We'll walk through this. 3 hours of this to any 1 hour of instruction is the way to do it. And again, this is why I front load the living daylights out of your weekend study modules, because I know as an instructor, part of your most valuable time for what I'm teaching you is going to be the time that's just between you and the charts, not when you're listening to me on some video, right? The time between you and the charts is well laid out for you if you like. 28 trades last week all identified for you. All right. Carve them up into various categories. We got a D1 trend thing going. That's nice to be able to carve these up. We got some AFPs from last week. I'll start to use this more and more going forward in presenting these end of the week trades to you. But just the D1 trends on their own is a really nice thing to be able to break out. And then AFPs, of course, right? Which one of them should be this GU. I didn't label it properly, but this bad boy right here is an away from peak trade to die for, right? See the 1, 2, 3 down. Okay, we had this one as a dual direction. One way was AFP last week. This is another one that looked like it could be L2 short, but it could also be AFP long. And then look at the W inside here. Very clean. Entry there, stop loss below. All right, now remember, these pullbacks give you an opportunity to load in. Now, what I like about this particular chart is the way they came back to that 0, 0 figure. Notice how they came back to it and then planted the little bitty railroad tracks, and that ended up being the shift phase. Okay? So I want you to walk through all this stuff 3 times the amount that you're listening to me jabber on videos. Okay? You can see some semblance of his own flip back here, but not a whole lot. It's basically sitting, it was price blocking these traps. Little trap through of that area. So again, W formation away from peak, super solid. So again, all these setups like from last week, of course, you can clear this. You can go into here to show which week. The week previous to that had 45 setups, a cajillion of them. Lots and lots of setups. So you can go into all setups and see that you have a good starting point for this discovery that you're going to need to do. It's 5,733 trades. Let's just see how many type 1 London patterns there are, because that's the meat. So 873 type 1 London patterns going back to 2017. And of course, if you have data in there, you can click it and it'll take you right to it. And it looks quite like the one we just walked through, didn't it? But again, you're self-programming yourself on the edge here. You're doing this offline work 3-to-1 times the actual education that I'm giving you through videos, right? Well, so obviously your ideal take profit was up here, but a 2-to-1, guess what? That's a great example of why just under 2-to-1 is the way to do it. And that was about a 2-to-1 on the pin. Okay, so this is 1 unit of loss, right? Your stop loss is down here, and then your entry is here. Okay, I picked a random one. Again, this is what you need to be doing. Go into these. And that was from 2017, the GC trade. Okay, so I leave it to you to manage your life in such a way that it becomes part of your education to take this 3 hours for every 1 hour of video instruction and make it happen. Because there's stuff in those moving candles that you just can't get otherwise. You need to walk this route. You need to be this person on this. I mean, the roads, look at this thing, it's way out there. That's where you're going when you're trading live, when you've got your second income and all that going, right? You can't get there unless you go here. Okay, so I want to just immediately just pile drive that into your mind. Okay, good. So that'll be the first part of our DMR here. Let's jump into, so we're going to carve into 15-minute increments. Okay, so for the next 15 minutes, we're going to go extract out another. This is, again, I'm showing you that you need to walk through these trades on a first-person basis to get the next level of education. You need to have that chart experience. And so a couple of weeks ago, we talked about this Australian dollar reversal short that we had spotted out in a pre-market session that worked out really nicely. So we had this incredible momentum down in the Australian dollar. Right, here is, again, a monthly chart. We already walked through this in a previous DMR, so I'm going to flip through it quickly and get to the part we didn't get to. Okay, we talked about all the container ships, the fuel ships, which were red, and the container ships, which were green, basically hanging out off the coast of China, which normally would be moving. During this time period, we were seeing Australia being in a position where their metal exports were no longer going to mainland China, so essentially the value of the currency of Australia, there'd be less of a demand on the currency because there was no immediate selling of metals to China. You get the idea, right? Super clear. We talked about that. We had this momentum to the downside that we're going to capitalize on. We're going to see this 3 moves into this targeted level 3 area. We're going to expect some type of false move before it happened. And it gave it to us with the first leg in the box and then the second leg out of the box. We already covered this a couple weeks ago, so I don't want to cover it again. And then we covered the algo historical, which is everything. Again, I've been hitting you with this from the beginning of this DMR by promenading out my 1.7 to 1 to 2 to 1, 75% hit rate M1 GU trade here, right? Which is basically London pattern on the M1 chart. Really not a lot added to it. But that's this idea to tweak your strategy to get those numbers up, to get the hit rates up, right? That's the statistics component of your education. You have to do that. And when you yourself do that, you have what's called empirical data. You don't have the social superstition. And then that social superstition, it's one step to being sucked into thinking that the size of the crowd is proportional to the value of its decision making. Right? One step, you're sucked into it. So you got to get out of the idea of social superstition. Someone else did this, I got to go follow them. Who's the hot shot of the week? I got to go follow. No, don't do it. Follow yourself and spend the time like all the sages have really digging into it, okay? From a statistical standpoint, win-loss, okay? That's what's going to give you your confidence, not wins. Wins do not give you confidence. Why? Because if you're trading, really trading with a leverage market, you're going to have losses and wins. Losses and wins. If wins give you confidence, what happens during the losses? Oops, forgot about that part. Well, you should be as confident during your losses as you are in the wins by having a nice solid win rate that you are able to trade into, which is usually going to be a lot more than 3 to 1 hours of offline time to develop a sheet like this. This sheet right here was 5 weeks to make, right? And that's going for days in a row for 6 hours at a swack. I mean, it takes a long time to do this kind of work. Okay, I want to make sure that's super clear to you. And that's why so few people do it. That's, again, the crowd is going to go for the quickie, right? That 10% that aren't with the crowd are going to do that slow, steady work here. Okay, so we walked through this type 2 London pattern. We called this a type 2C. Okay, we've talked about that. And, of course, this brings us to where we stopped our presentation last couple weeks ago. So now we'll spend our remaining 12 minutes on this. So you get this type 2 London pattern, and it comes down to the Asia midline. And you ask yourself, am I going to cut out of my trade here? Am I going to take profit here, or am I going to hold for the bigger run? Right? So I hope by how I've laid out this presentation to you tonight that's not even a question you ask on the edge of the chart. You've already answered it. In my case, I'm taking profit there to get my base hits so I can keep compounding my 75% or greater win rate, right? But someone else might be, I need to make more on every trade. And they're in that mentality, which is, again, it's part of the madness of the crowd mentality is I got to make more. No, you have to basically get base hits. You have to build one brick at a time that becomes your trading account. One brick at a time, not, again, I'm trying to get you out of this idea of the superhero mentality. It haunts us all, coming from someone who got imbibed in it to a great degree. Okay, and this is where I want to lead with this. How many trade setups do you see in this chart? Think about that. How many trade setups do you see in that chart? And again, this gets into the perception of the market. And when we're so busy watching videos, we're so busy watching, this or that person who's doing great this week, this or that person who's basically stolen the material and gone out and sold it, and spun it with their own variation of it or whatnot. You never have this type of perception of the market because you haven't sat with the market yourself on your own, looking at it, comparing it to that 3-day class that Steve gave, saying, well, in that 3-day class, he talked about something, and wow, I see more than one setup here. Okay, so good. I see a couple people giving a setup name. Someone has said a 22 trade. I might go with that. It's a little bit beyond the daily, previous day's high-low. I'd rather see a 22 right under it, right at it. I don't see a 22 going above it all that much. Oh, last week. Okay, sure. Gotcha. No worries. Okay, so there are two setups. There's a type 2 London pattern, right? The type 2 London pattern. Let's get out our little diagram here because this is, again, you're given a diagram, but you yourself have to walk the road with that diagram. You can't just pretend that just because you have the diagram, it's going to do the work for you. You can't be thinking like a chimp. You have to apply it. So this diagram right here, we had the extended second leg right here. Okay, extended second leg type 2B. Just to let you know, we do have a overlap. It's a brand new type 3, which is fantastic. And that is where we have, and we had one last night actually. We had a lot of these going forward, but that type 3X, I call it, because it's, to me, it's the crossing of cars teaching and the stuff I'm bringing out. Obviously, you've got the type 3 London pattern. At the same time, it's an AR move. Okay, so let's find that from When was it? Is it EG? Yeah, it was EG last night. It's an absolutely gorgeous example of this. Okay. You had nice momentum on the D1 chart. Your D1 chart was in a fade. We had this actually. I did stick it onto the daily trade organizer just so you could have it. Right? Had it as a level 3 long, rather. Or didn't really. We saw the possibility of a level 3 long, but whenever you see level 3 long, don't discount the D1 trend. Always ready to take D1 trend moves. Again, now I do specific work with D1 trending moves in relation to these databases. Not this specific trade right here. This M1 trade was not in relation to D1 trend, but I've gone back and gotten 80% and higher by looking at type 2 and type 1 London patterns in line with the D1 trend, completely forgetting about the cycle. Just going in line with the D1 trend. So this is a type 3 London pattern with an AR move in it. See that? So that's our AR50 type 3X. Okay, so let's get with the program here. The lesson. So you have a type 2 short. So that's a type 2B short, right? One leg in the box, one leg out of the box, higher, right? Now the other trade, does anybody else see it? You see it. Okay, good. Okay, I've got, all right, Vinesh sees it, of course. It's a type 1 London pattern on the M1 chart. Okay, so this is where the world opens up. This is where the music starts playing and things, magical things start happening to people that begin to look into the market in the lower time frames. When a higher time frame setup shows up, I dare say you could get a 5 to 6 to 1 on an M1 entry inside here. And we'll show you that that was actually possible. And it did happen. But there are these setups nested within setups. So this is something, I mean, if I were here for 1,000 hours, just continuing till, I don't know, if I went to 7 p.m. next Tuesday, and I just kept this webinar open the whole time, and obviously Steve would have an issue with that, we know that, but if I just kept this thing going for a week, I couldn't take you through all these variations. This is stuff you have to see on your own, right? Okay, so this up here would be your M1. And we know that that is going to turn into an M1. So we'll go through that as we get there. So I want you to consider cutting your charts up. And this is what you get with the WSN Viewer, where you walk through setups. You see that zone flip anchoring up there? See that? This kind of thing is going to start to register if you program your mind to see it. And then there's the result. So you need to find a way to walk through these charts and identify for yourself where these zone flips are. And what I like to do is I like to take it all the way down, and then the pullback directly to the zone flip. And then before the next red candle forms, I like to watch the zone flip. We could say this is programming zone flips into your mind by walking through charts. This is a way to do it. I wouldn't take every single candle. For instance, I wouldn't go through this thing one candle at a time. I wouldn't do that. I would set up these little waypoints where you can click through it and watch it and watch these zone flips play out. So that's your zone flip, right? And then the next candle is the red candle. This acts in a way like your shift bar valid entry candle on a London pattern. Capiche? See how that works? So this is my role. I guess we could say this is the beginning of the move away from the zone flip. I want to program that into my brain and see that over and over. And it turned into a nice move to the downside. But again, spending time on the charts, programming your brain to see that is everything. Okay, comes forward, we see the close above the catch-up, close back down the catch-up, close back above the catch-up. What's happening here? Are you still holding your short trade? Question for the group. I will think about that. I will definitely think. I think that's a great idea. I'll do that. I know those are massive. So Farham is asking this. This is a great question here. Can you add zip files with 2017, 18, 19, and 20 full historical data with all the M1 charts? So do you mean individual years? So 2017, all the M1s, 2018, all M1s, 2019, all M1s. Yeah, I think that's going to be doable. It's going to be a massive hightail link. I think that'll be something. I mean, what are our M1s are 6 gigs a week? I think I got it down to 4. So 4 times 48. Those are going to be big files. But I see what you mean. I see what you mean here. Yeah, let me think about that. I'll do something to make that easier for you. Just remember, when you work with Hightail, you can have 10 or 12 downloads going at the same time. It's really easy to do. If I made a Hightail of this, it would probably lock your computer up for 24 hours to download it. So I'm slightly hesitant to do gigantic files for that reason, because the dropouts and such. make it a problem. Individual files are better because it's less subject to dropouts. You're restarting the file download each time. So there's a limitation to that, but I'll think that through. I think that's a good suggestion. All right. Okay. Yeah, it's true. It is an investment. Anyway, okay. So you're all seeing that you're probably not going to continue short, right? We know this is going to break higher. You've got that confirmed W on the bottom edge, right? You know it's in the New York session box. See how it's in New York session? All right. Can you see the 3 down inside here? This would be your 1 pullback, 2 pullback, 3 down W. That's a long. Okay. There's your pullback to the 0-0. We showed that with that EU trade. Or no, it was a GU trade. I'm sorry. Where it pulled back to the 0-0, right? That's the last move back to the 0-0, and then it bounces higher. And it doesn't bounce a million pips higher. It does what? It goes to the zone flip at weekly open price. That was the price that the week opened at. A very strong high volume area typically. And look how clear the zone flip is. Look how it's been dealing with that area. Right? So that's a good place to cut any longs in here. Right? You're late in the day. This is tea time, so that's 11 a.m. Eastern. So you can cut your longs at this point, certainly. Don't want to add into your shorts. Basically, your short was right here. But I'm trying to show you how you want to spend your time walking that big desert road on your own with the viewer. Or, I did this in Windows Paint. You could conceivably do it in Windows Paint. I like the viewer because there's all the real time, right? You have the real, exactly what that data was. I absolutely cherish that, to be able to see that. And spreads, what the spreads are, to see them widen at certain points in time. On news events, you have the news, obviously, in the later charts, right? When you get into, later on, we added the news in here, so you're able to see real-time news. I like to be able to see that. But as you're walking through, so here is your zone flip, and it collapsed right back down. Okay, so again, a long trade in here, absolutely valid. Okay, now what do you see here? And again, these are moments that are on this timeline that should trigger events in your brain. Like, okay, that's a W long. I'm going long. Okay, so these triggers. Now notice how I cut this chart up to only the trigger events. I only went to the key areas. See how I did that? All right, see that? It's a very, very strong technique here. And I know, for example, in the WSM viewer, you can do the same thing and stretch it out. I'm not even going to manage trying to do something coherent here, but you can go Control-Shift-S as in Sam, and that saves a blue dot. And then you can go to the next one, Control-Shift-S as in Sam. You can save these blue dots all the way through a setup, right? And then you can hit the F1 key and learn where the hot key is for advancing to the next blue dot. It's in here somewhere, right? So you can go to the next blue dot with the viewer, and it'll take you from dot to dot to dot. That's a more time-efficient way. It keeps you on point. More time-efficient way of getting chart experience that you have to front load. Okay? So now let's jump down to the 5-minute on this set. And you can see, again, double railroad tracks. Double railroad tracks is often a very, very powerful setup at high or low of the day. Inside there's an M. By definition, it's an M. Okay? So that's a short right there on a 5-minute. Understand that it's not below the EMAs. It doesn't have the trigger, but there are 2 railroad tracks. There are a set of railroad tracks. We know that implies something really nice on the M1 chart, right? But let's just walk through this 5-minute. So we're going to take the same setup. This was the type 2 London pattern. We're going to walk it through on the 5. Now we're getting our close below the EMAs. That might be a more comfortable time to take your entry. Certainly viable entry right there. Okay, remember all the higher time frame stuff going on in this setup. Short, Australia, locked up, right? Cargo containers off the coast of China not delivering ore. No demand on the Australian dollar going to make it fall off. And then we have the floor trader EMAs here, right? Rolling over nicely, holding price on the pullback. We've got our zone flip. It's another advantage of our zone flip. You see it? And again, I'm creating a flashcard right to the zone flip, right? And then the fade away from it. What we would consider as the trigger entry away from it. And then it'll drop. So I'm programming my mind to see zone flips this way. Okay, pull back to the zone flip, the fade after, and the fade after, and then the drop. See that? So I'm doing that. So I could walk through this chart within a couple seconds, and I don't have to go every candle and lose my focus and lose my direction. So I maintain that making sequence charts and you can make videos of this, of course. That's a whole other dimension, but you can do that and walk yourself through all these. and get a real handle on zone flip. So that's the 5 minute. Let's go look at the 1 minute. Okay, first move up, pull back. Right, again, plotting out the reversals, spending time on the reversal candles, including those. Don't need all this noise, but this is the last move before it jumped higher. I want to see what it looks like as it jumps higher. Okay, possible push 2 with the pullback, very nice. There's our push 2 pullback, and then here's our push 3. You can count the 1, 2, and 3 up. And there's a high of the day candle that comes down into a pin, right? Followed by another one that tries to jump into high of the day, pulls back into a pin. You'll see this in real time if you're doing the high-low drill on the M1 chart. Then we've got the pullback. This represents the first leg of a possible M formation on the M1 chart, right? And then we've got the move higher, and then that railroad track on the M1. This is what created the double railroad tracks on the 5 minute chart. And so now I've got my entry. And see how I walk through that? I didn't do every candle in my flashcard sequence. I basically went to the key areas to try to program that in. First leg, second leg, railroad tracks, pullback. Stop loss above, entry, right? For a 1 minute entry on this move. The inevitable pullback, shaking the tree, and then watch it roll down. And I'm doing the same thing. I'm using this idea of pulling back to the zone flips, the closest, the highest point to the zone flip, and then I let it roll over and then bring it down. You're going to see this over and over again, this theme that develops here by walking it through this way. So this zone flip is back to left. And notice I'm purposely not putting the zone flips in here also because I want you to see them. I want you to be able to, in your brain, throw out a probability matrix of this one, this one, this one, and this one being possible with zone flip areas. Okay? See how that works? And then this one, interestingly enough, came against yesterday's high of the day. That was a clear zone flip anchor right there. It's also pulling back to the 13 EMA from the 15-minute chart, which is the catch-up on the M1. And then it's rolling over. Okay? Again, programming the brain to see these zone flips. Here's another one right up under here. Okay? Does it roll over? Yes, it rolls over. Bam, down it goes. Okay? Now you're at day open price. Again, I want to pull it back to where the most intense pullback was. Right? So this is the tendency is very strong to cut out of a short here. Now, being that I was able to get my 2 to 1 on this, I'd already be out. But that's all right. If you were holding it longer, you would ask yourself the question, do I want to click out of this trade here? So there's a reason why you might not have clicked out of this trade here. What type of trend do you see here, guys? If it holds this area right here, what type of trend do you have? Type 1, type 2, or type 3 trend? Question. Anybody? I'm asking you to see a fib without actually drawing it on the computer. Actually drawing it on the screen. Type 1 is correct, Noma. Okay, look at it. Gives you a double leg right up against the catch-up. Now, for some of you, cough, cough, Noma. For some of you, we can talk about using the waterline in an intraday manner where you take your trade off and then you add in. And add in on a type 1 trend will be very nice right here. Okay? So for some, the few, the proud, the many, the few, the proud, the bold, that becomes an entry basically ticking a 382. I mean, that came right to the 382. The bounce off the catch up. So your first trade could be this series right here, and then your second trade can be this one. All right. For some people, that'll be interesting going forward. Okay. Now, again, I take it. If I'm going to be faked out of this thing, I want it to be as part of my flashcards. I want to see the game. And what is the game? A third leg, a move back up, a little inverted hammer. See the inverted hammer right there? And then a roll over. So shaking the tree is going to happen out of your entries. You're not always going to get an entry and then it takes off in your favor. But when you walk through charts like this, you begin to program yourself to see this kind of thing. So that, to me, is 3 hits to the high at a 382 pullback at the catch-up after a full cycle down. And now we basically are in a reset for the move. Okay? And there you go. Down it goes, and we pick it up as it drops. Okay, now you're in a type 1 trend for sure, for certain. That means its tendency is to run further. But you're going to have these pullbacks, and I want you to spot them to their most tippy-tip extreme, and then the candles just after, right? There's an M. See how I did that? I created the first leg and then the second leg, and then down. Okay. And every time there's a pullback, I want you to do this. Create a little sequence that shows the little zone flip and then it rolled over. Little zone flip and rolls over and down. Over and over you go. Tracking it forward. Bringing it back to the zone flip. Slight rollover. Wherever it terminates, right when it's about to take off, you want to have a little picture of that. And then down she goes. So you're putting into your mind the proper programming. Right? Program your mind. It's the way to go. So this trade right here, this M1 entry, that would have been 1 unit of risk, 1 unit of risk, 2 units of risk. That's why, again, the 2 to 1 on the first move. It's almost universal, even on M1 charts. I got my 2 to 1 inside here. Do I want to load a speculative position here using part of my profits? Absolutely possible. Definitely with all that high time frame stuff going on. But if you held this thing through the pullback, you had 1, 2, 3 units of risk, 4, 5, basically 5.6 to 1 on this. Okay, that's the way that I would say you could take a large trade like that. I'd rather be out here closing some of my profits and then get back in here for the rest of the move down to get this 5.6. When the hold through this pullback, it's just not me. Some people do, some people don't. I don't even see Steve holding in these pullbacks anymore. Steve takes the first impulses as well. Anyway, we've learned to scalp in a way. I know that's not technically scalping, but it is in a sense, right? But this is how I want you to start to see this as a possible add-in, or for FIFO members in the U.S., you have to take your trade off and then put another one back on, unfortunately. Look at this as a second trade short, okay? Obviously, you can add in, but you'd have to take this one off before you took this one off. Here, domestic U.S. But you get the idea. All right, start to think about these pullbacks as add-ins, okay? And I want to just open your brain to it here in a sec. So that became 11.2% gain on a 2% risk if you basically just held this thing, which was certainly viable because you had this, what do we have? A type 1 trend the whole way. Type 1 trend the whole way. Now, when we got down here, it couldn't even pull back to the 382. But this one pulled back to that 382, planted the 3 hits to the high across the catch-up from the 15-minute. Excellent short anywhere inside here, right? So use these, what we've previously designated as Fibo filters. Use these for possible add-ins or re-entries to maximize your take on the day if you're so inclined. And I do suggest you want to at least, if you're an international trader, take at least half off on this first move and then wait for the pullback and then add in again and then take it all off down here. That's the way I do it because I want you to start to bank some of the profits on these moves. But that'll give you a nice opportunity for those that are outside of the U.S. regulatory system, which unfortunately right now we have to, you would be best to take the trade off and then add in again here in the U.S. You can't take half off and then add in and then take, you've got to be first in, first out. It's a mess. But anyway, you get the idea. You can make a good living doing this stuff. And I'm planting that seed there for certain folks. The pullbacks to these fibs, especially when they're at a zone flip, when you're at something like a strong EMA, can be add-in points or re-engagement points in a trade. And people get into this conversation about fibs. You know, are fibs real? Are they fake? Are they crap? Is it real? Is it you're talking about something that's in nature, man. Fibs are everywhere, yo. It's not like you're going to pretend that they just disappear. So it's a structural facet of nature. No matter how seemingly chaotic an environment, natural law always rules and pervades. Look for it, seek it, act within it, and success will be the dominant outcome. It's the way it is. So what causes these pullbacks to these 382s that hold and then it drops further? I don't know. I think my belief system is that bankers are using these fibs constantly when they're running pullbacks. I do believe that they're sticking to it, but whatever the reason is, it's there and it's in nature and it's going to continue happening. So you can leverage that on possible add-ins. Big piece of the puzzle there. Remember your gaming outcome flow. You need to get your brain really, really well wrapped around this one, right? You've got to have your idea of catastrophic losses, just basic losses, and the rest wins. You have to get into a very clear outlook of this so your stop losses can be no big deal, right? Okay. So that completes the second part. Let's get on to our third part here. We'll do this in 5 minutes. I don't need to take a lot of time in this. This is obviously we're into the extra credit component here. And again, I'm not a medical doctor. I'm not going to give medical advice. Seek that from your medical doctor. I'm not going to try to sell you anything or in any way compel you to not get treatment from a licensed practitioner. But we can see this COVID thing, starting to get some resumption of power going back here. I don't know how accurate this chart is, but we're not quite at 2019 levels of power consumption out of China. Hopefully that gets back up. Okay. I want to talk about this induced trap shift. We introduced this to you a couple of weeks ago, or was it last week maybe? I've been wanting to cover this for the longest time, and that's the madman version of the dealer's playbook, where the first objective is to induce fear. The second objective is for you to over-medicate and pay a lot of money using synthetics. And then the shift phase is when those side effects start to hit you and you get a compromised immune system, in which case more fear can be added to get you into getting more synthetically over-medicated. Now, I'm not talking about medicine that's necessary, right? I believe in synthetics. I'm not someone who's against it. I love my aspirin when it's time to take it. I love my azithromycin when it's time to take it, an antibiotic, right? I love those things. I'm not against them. But if you want to get your head into this thing in a way, I'll leave a link for her. I'm not going to cover this information. It's way too hot to handle. But just if you're of a mind to do some solid research, she's a virologist, Fort Detrick for 20 years. She helped create the protocol that allowed AIDS patients to walk around with that virus and still live. She's a very decorated hero in terms of the actuality of scientific endeavor, but she decided that money was not her god. And she turned away because of ethics from that world and got utterly destroyed, right? But she was in for many years, and she knows viruses like nobody's business. This lady's extremely gifted. And by the 140 mark here, 1 hour 40, I'll leave the link for this video. Somewhere around 140 mark, the host said, my God, someone has to go back and slow this thing down and take notes and do research off of it. So it branches out into a research of this whole COVID thing in a way that's truly difficult to describe. Okay, there was a lot of stuff going on that should be of interest to you, but once you get 15 minutes into it, you'll know if it's for you or if it's not for you. And if it is for you, I'll guarantee you it's going to be very difficult to pull you away from the computer for that 1 hour and 58 minutes that this conversation goes on for. And you're going to learn a lot about obligatory parasites, which is what a virus is. It needs water to survive. It needs a liquid for it to survive. Guess what? California is dry. There aren't that many cases going on in California anymore. Do you think that matters? Yes, it does. Okay, things like that, all right? It's incredible the work that she's done. And it's going to give you a scientific basis that will allow you to carve your way forward during all this stuff. And this guy's definitely going to freak out by that whole thing. But let's talk about results here. We're a results-oriented group. Michigan Holistic Physician, 85 COVID patients treated, 0 hospitalizations, and no deaths. 85 COVID-19 patients treated, 0 hospitalizations, no deaths. Whoopsie. Yeah, we need to ring the bell for that one. Okay. What does he use? Zinc, vitamin C, vitamin A, iodine, some nebulizing. Okay. He's not going this route. He's using a powerful immune system building technique, which is another way to handle health issues. And unfortunately, because of this proportional validation of the crowd, we haven't been led into it this way. It's unfortunate that it has to be these underdogs, these outliers, these alternative anecdotal people to come up with this stuff, but you need to powerfully fill your immune system. That takes care of the funk. So what this doctor has done is he's used powerful fuel for the immune system. Okay. And instead of the fear thing, he's had faith. And so I don't know. I like to see this type of number, 100% hit rate with 85 COVID patients. I like those numbers. That's going to induce a certain amount of faith. Okay. And then of course we know that generally speaking, the medical industry drops about 747s a week of people that are properly diagnosed, properly taking their medications, properly doing their treatments. That's 747s a week go down every week in the USA on its own, just through this over-medication and synthetics. Okay. I'm sorry. It's facts. It's statistics. I'm not some weird conspiracy nut. You can go look at this. It's a reputable figure here. Okay. Every week. It's 1 a day. And I think it's actually more than this, but I did the calcs to see how many would fit in a 747-800 or 747-400 rather. And it does, the math adds up. Okay. So you got to watch out for this trap here. Okay. So what we're talking about is non-synthetic, but powerful substances. And you think to yourself, well, in your brain, you've got this idea of a medicine and a supplement. You say, well, one thing's a medicine, one thing's a supplement. Supplement's not that powerful. It's made from plants. A medicine's strong because it's made from synthetics. Well, guess what your hydrochloroquine is made from, guys? Guess what it's made from? Guess what its source is? It's insane. It is actually a plant. That's the source of this. And this plant has treatment to prevent malaria, anti-malarial, but a whole host of nasty side effects, really nasty side effects on this bark. So hydrochloroquine, the hero of the day, yes, it's got pretty white pills, actually is made out of bark. That's one of its core ingredients. All right. So just to make you aware that plants can be extremely powerful too. Okay, its side effects are nasty. It's got nasty side effects. It does. Coronavirus traces found in Massachusetts wastewater at levels higher than expected. We told you that 3 weeks ago to get a distiller. So you're not going to get it through your tap water. Type into Google medicine found in the tap water. You're going to get it all up. Pharmaceuticals in treated tap water. Yep. Sorry about that. This monoclonal will be in there as well. Some degrees of it. It loves wastewater. Again, a virus is an obligatory parasite, so it needs a wet host for it to survive. It needs a cell first to survive, and it needs a wet host. It needs the host is the cell, then it needs the wetness for that cell to remain alive. You dry it out, you make it wet and hot, it doesn't exist, okay? But it was found in the wastewater. So if you got your distiller, like I recommended 4 weeks ago or whenever it was, I don't know, long time ago, you're on track. At least in Massachusetts, they're finding this stuff in the wastewater. Can you believe it? And just a high five to Boris Johnson. He's out. He did great. I'm really happy. He looked great. His speech was amazing. He looked like someone who might have had some ozone. God, I only hope. Right? Just a little quickie here on Queen Mom. She did us a favor. I want to just thank her. She obviously transitioned in the early 2000s. But the reason that this information about ozone hit the public is in part because of her. Prince Charles, I read this after posting this for you guys. We'll just close out with this little bit of, I don't know. I think it's cheery. I like the fact that the Queen Mom actually did this for humanity. Prince Charles, whose interest in fringe treatments is well known, suggested alternative medicine for his grandmother, who celebrated her centenary year, August, after a lifetime of mainly good health. She let slip the treatment to friends when they commented on how good she looked. So she talked about the ozone treatment, which, if, again, you study this stuff, would kill all of these things on contact. It does kill it on contact. It's an amazing treatment. It's really the way to do it, I don't know, closed spaces, submarines, aircraft carriers, all of it should all have ozone treatment. It's so obvious at this point, but we're grateful for the Queen Mother actually letting this slip. Now, do you think she did that on purpose? I do. Absolutely do. And the entire mechanism of the medical community closed down around her and hid this idea of using ozone infusions for any type of medicinal benefit. Yet she managed to get that out there. And again, big high fives to Boris. He came out of it. We're so happy that you're healthy, buddy. Really, really happy about that. Okay, so I'm going to drop the link. Dr. Judy's pretty amazing. And as well, I want to wish everybody excellent health. Hopefully you're staying stress-free as much as possible. That's the one thing I'll close out here. With this 1.7 to 2 to 1, it's very stress-free. Very stress-free. So we'll wish you guys excellent trading tonight. I did miss some of the questions. I'm going to save the queue here just to make sure I save the question log. I want to answer all those questions. I'll do that during the week, direct to you guys. And those will hit your email most likely. All right. So if I missed your question, I do apologize. We'll be back up here in just a millisecond to do our pre-market session. Want to throw out a big hug to everybody.